There are a few factors that you should consider when trying to decide whether to pay down debt or invest your monthly surplus into the market. And the first thing that you need to consider is your investment option and the return that you're going to make on that investment or those investments relative to the cost of your borrowing, which is your loan. And the second thing that you need to consider is your risk tolerance. And finally, the third thing that you need to consider is your cash flow situation. So let's take a deeper look into our first consideration, which is how to understand whether sinking your money into an investment is going to provide a better return than paying off more of your loan. And so essentially, what we're looking at here on the screen is purely a mathematical perspective, and that is your decision um, or that is your decision should look at the after-tax cost of borrowing versus the after-tax return on investing. And so really what this means is that suppose, for example, you have student loans that have an interest rate of 6%. Depending on whether the interest on these loans is deductible, the after-tax cost of borrowing might actually be closer to, say, 5%. But for this example and in this chart, we're just going to assume that the interest rate stays at 6%. So if you're debating whether to invest or pay down more of the debt, then you would ask yourself if you have investment options that will give you annualized returns greater than 6%. And in this particular situation, what we see here is that our after-tax investment return is not greater than 6%. It's 4%, which means that it is actually in our best interest from purely a numbers perspective to continue paying off our debt. The problem is just looking at a pure numbers perspective isn't good enough. And that's why we need to look at consideration number 2, which is your risk tolerance. If you're a young millennial, for example, and you can weather some volatility in your investments, it might be worthwhile for you to invest aggressively instead of paying off additional debt. Likewise, if you have a higher percentage of equities in your portfolio, you may find that you are able to get a better return by investing that extra surplus by investing the extra surplus of cash each month. Or if you are an entrepreneur, you might find that investing that surplus cash back into your business is a better decision than trying to pay off more of the debt. But on the flip side, let's say if you just really want to be debt free, get rid of that psychological burden and rid yourself of that burden that is student loans, you might decide the opposite to continue paying off your loans. Or perhaps you are heavily risk adverse. You can't stand the thought of volatility in assets. Then you might decide that paying off your loans isn't actually the best option for you. And so you can see here that in addition to a numerical consideration, there really is also a psychological consideration as well. And it's going to depend pretty heavily on your particular unique situation at hand. And so the third and final point that you should consider is your cash flow situation. And before using any monthly surplus to pay down excess debt or invest in the market, you should absolutely have a 3 to 6 month emergency fund already set aside. And this is because if God forbid something happens to you, you end up in the emergency room, your car breaks down, you lose your job, whatever it may be, you need to have the cash, the liquid cash available to pay it off. And in a similar vein, you need to also ask yourself, do you have any credit card debt that needs to be repaid? Why is this important? Well, the reason why it's important is because your credit card interest rate is almost certainly higher than what you might earn through any sort of investment. For example, today nobody is making 15 to 20% rates of return on their investments, but that is actually often what the average credit card interest rate might run you. And so it is much more important to pay off a 20% credit card interest rate than to try to earn 5 or 6 or 7% in the market. And the last thing you need to consider here is that is whether or not you're going to need any excess cash anytime soon. So if you're self-employed, you need to ask yourself, do you need an extra cushion of free cash flow just in case something happens and you need to keep the doors of your business open? Or maybe you're helping to pay for a wedding, or you have big travel plans that might require excess cash. These are all sorts of different various factors that should help you decide whether it's even worth spending that extra surplus of cash that you are gaining every month on debt or even some sort of investment. And so to recap here, we've discussed three factors when determining how to allocate your excess monthly surplus of cash. First, what is your expected after-tax rate of return on investing relative to the after-tax cost of borrowing? And you need to consider what is your unique situation and risk tolerance, and should you actually be putting that money elsewhere, for example, maybe in an emergency fund. The last thing that I want to end here with is that if you're looking for help in these calculations, aside from the psychological calculations, if you're looking for help with the numerical calculations, I've listed here at the bottom of the screen a link to an online calculator that will help you determine how to allocate some of these funds. So hope this helps, and looking forward to seeing you next time.